everybody, this is Tom Nash, and the US market had its worst day of 2025 on Friday. An absolute bloodbath. Everything sold off, Palantir is down, Tesla is down, Nvidia is down, and a lot of investors are sending me messages privately and on our Discord asking me, is this the end of the run? I mean, we had a great run. We made a lot of money over the past 2 years. Is this the right time to get out before the crash happens? Now, in today's video, I'm going to answer that question. And this is exactly the sort of video you don't want to miss, especially if you're new to the market, because I'm going to be sharing a lot of very important things. So stay on this video, not the video to skip. Now look, the S&P 500 actually dropped 1.7% on a single day on Friday, which is a big deal, but not as big as mainstream media wants you to think, and I'll explain. Yes, when an index drops like this on a single day, it is unpleasant, and the shock waves are felt across the board. I mean, Palantir was down 14% on a single, 48-hour window. A lot of this is unpleasant, but the real investors can tell you that the S&P 500 has a lot of pullbacks throughout the year. Historically, it's absolutely normal. This 1.7% is not even big enough to be counted. We know that at least 3 times per year, every 4 months on average, the S&P 500 is going to drop 5%. It's a big drop, a lot bigger than 1.7%. And once per year, the S&P 500 actually drops 10%, which is massive, especially for a stock like Palantir, which is going to be down like 30-35% if that happens. Now, because we understand that this is normal and the S&P 500 has this volatility built in, when we see a bloodbath like we had on Friday, when it drops, let's say 2%, we're not really that emotional about it because we know it's not even the worst of it. We haven't really seen a pullback like the one we statistically should have for a long ass time. So this is no big deal. But let's talk about the reasons of why the stock market is having a little fitsy fit right now, right? What's going on? What's all the hoopla about? Well, there's mainly 4 reasons for why the stock market is a little bit wobbly right now for what you've seen Friday, right? Number 1, and first and foremost, the reason is that the market is afraid of a recession, right? It's always the recessionary fears that lead the market to slow down. And obviously, the stock market mainly suffers when this happens. I mean, the economy and the stock market rarely kind of work opposite of each other. If the economy drops, the earnings drop, the way we are paying for stocks changes. We're not agreeing to pay as much for multiples as we had in the past. So a lot of the dynamics of the stock market and the economy is tied in together. So because we have so many recessionary fears right now, the stock market is a little bit wobbly. But then again, you might say to yourself, well, Tom, I'm a new investor. Maybe I don't understand this, but we have all these jobs. We have all this money in the economy. The GDP is doing great. I mean, there's no economic recession in sight. Where is it coming from, Tom? Well, here's the thing. You have to understand that the stock market is a future perspective market. So whatever is most likely to happen is going to get priced in as the reality today in the stock market. But then again, you may ask, well, Tom, what kind of realities is the stock market foreseeing that show us that there might be a recession on the horizon? Well, the main thing that people are terrified about is the tariffs. The Donald Trump tariffs that are supposed to basically collapse the U.S. economy. Now, on top of that, of course, you have the Fed being stubborn and basically slowing down and dragging their feet with lowering interest rates. They've promised they'll do it, like Dad promised to take you to Disneyland, but sometimes it doesn't happen because he has to work through the weekend. Personal story here. But I'm saying sometimes it doesn't work out. So Daddy Fed promised to the kids, the investors, lower interest rates, which means more money to everybody. But then they didn't keep the promise and they're saying, well, maybe later. Maybe we'll go next weekend, right? So they haven't changed the policy. They haven't said they're not going to do it, but it got pushed back a little bit later because inflation is not coming down to 2%. It's at 3%. A lot of fears about the tariffs, a lot of uncertainty, and the economy is doing great anyway. So why do we need to boost it? So the Fed is pushing back the timeline of said money presence for the market because low rates is essentially giving money away for the market, which is great for stocks. But that slowing down is causing the market to kind of throw a hissy fit. And then on top of it, you have the tariffs. Donald Trump is talking about tariffs, tariff this, tariff that. I mean, the man has no other vocabulary than a tariff at this point. He solves everything with the tariff. The weather is bad, tariff the weather. At this point, a lot of fear because these tariffs, eventually we understand how they're going to work, because if we apply taxes on incoming goods, eventually these taxes are going to be rolled over to the consumers naturally, and the consumers will have to pay more for the same products, and those extra payments are going to push up inflation and diminish our buying power, and then eventually that might be recessionary and inflationary, maybe even causing a stagflation, which is an elevated inflation and a recession at the same time. So that is the fear, right? That is the panic because of the tariffs, etc., etc. Now, if you look at the University of Michigan market sentiment, consumer sentiment, it is down. It is down to 64%, the lowest it's been since 2023. And a lot of people are looking at that as an indicator. Why? Because, well, recessions are kind of self-inflicted. And I'll explain. A lot of time where we fear that there may be a recession on the horizon, what we do, we stop spending. And we say, well, if we expect bad times, maybe it's not a good time to buy that new vehicle or the new house or the new television or whatever the case may be, right? So we're slowing down our consumption in anticipation of a recession, therefore causing a recession to happen, because if everybody stops spending, retail sales go down, people lose their jobs, they spend even less money, and so forth and so forth. So a lot of this recession stuff are cyclical. They're almost, a self-fulfilling prophecy to a point. So when you have, consumer sentiment being down, a lot of people are saying, well, that is, a good reason to be afraid, to be fearful about what's going to happen. And they get it, right? And the problem is that it's very easy, especially for a new investor, to get drawn into these macroeconomic data points and assume that they basically tell the whole story, but they're not. A lot of these data points, they come out negative. The next time they come out positive. It's not a good way to invest. Now, I'll show you something. Back in August, we had a horrible jobs report on the 2nd of August. Absolutely horrendous. We had a horrible sell-off. The stock market fell, crashed, and burned. I think we had a 3.5% drop on a single day, which is 2 times worse than what we've seen on Friday. Absolute bloodbath. And as a result, the S&P 500 dropped from 5,500 to 5,186 on a single day, no less. Now, of course, all the banks and the analysts came out saying, well, we're increasing our likelihood of a recession prediction to 30%, 40%, 50%, a lot of panic, right? But then, from that point on, from the 5,500 point, not from the 5,186 that we've seen, not the bottom, well, we're still up 10% from the high point. So nothing happened except short-term noise. It's loud. It's like a fart. It's very unpleasant, but it goes away quite quickly and nobody remembers. And of course, people will tell you, well, Tom, this time it's different. Donald Trump and the tariffs, it's for real. It's going to ruin the economy, etc., etc. You know how many times we had good reasons to sell the S&P 500 over the past 15 years? Countless times. Countless. So many reasons to sell over the past 15 years. War, pandemics, crashes, everything, you name it. And yet the S&P 500 did 700% over the past 15 years. But Tom, what about the high interest rates? I mean, the market can't withstand another year of high interest rates like this. Well, look at 2023 and 2024. We had higher rates than now. And we still did 60% in 2 years on the S&P 500. Besides, they will bring down the rates toward the end of the year. It's not like they're going to raise the rates again. But Tom, what about the bubble? The AI bubble. What bubble? All the Mag 7, all the AI companies are making money, are profitable as hell. They're all generating cash flow from AI. It actually is working. Comparing this to the dot-com bubble is silly. Besides, the average bull market in America lasts about 1,500 days and yields about 150% on the S&P 500. We're about 60% into it out of 150%, and we're about 800 days into it out of 1,500 days. So by the worst of worst scenarios, we're halfway through the bull market. What bubble? Now, the big question for every single normal investor, not a trader here, is what do I do here, Tom? Well, the answer is quite simple. The greatest cost is not investing in the stock market. It's not the crashes that kill you. It's the staying out of the market. Peter Lynch explained this. More money has been lost bracing for impact than the impact itself. Now, I told you a second ago, the S&P 500 did 700% in 15 years. But hear this, right? In COVID, we had the stock market crash all the way down to 2000. The S&P 500 went to 2000. If you sold at 2000 and said, well, this market thing is not for me, you have missed out on 3x on your money in 5 years. The worst time to sell is when you have a downturn, when you have red, right? You have to get used to buying when there is blood on the streets, even if the blood is partially your own. If you understand this concept, it doesn't matter how long it takes for the market to recover. It can be days sometimes, and that's great. It can be weeks, not as great. It can be months, that's hard. Or it can take a year or 2 or 3, which is extremely hard for the inexperienced investor. I get it. And the only way to survive this, should this be the case, is to learn and make it a habit of buying the dip. Learn to trust yourself, learn to buy the dip, and learn to ignore the short-term noise and the panic. It happens by surrounding yourself with people who get it, with smart investors, with long-term mindset investors, not traders, by understanding that your thesis is solid. The companies you've invested in are great. Nothing changed the companies if some bad macro data comes out. And understanding the fact that the best time to accumulate the stock is when it's down. If you're holding a stock for the next 10 years, the opportunity is on the downturn, not on the uptrend. It's opposite for investors and traders. Traders want to do it on the way up. We do it on the way down. So then 3 years, 4 years, we get to say, hey, I bought Palantir at $6, at $10, at $15, at $20. Traders sold off at that time. Completely different game. Know who you are and understand that the best way for a long-term investor is to make money through dollar cost averaging into the S&P 500 and then into a few select companies for the next 10, 15, 20 years, and to double down when the time is right. Now, I teach all of these things, all of these principles to my 1,300 students in the academy. There's a reason why I have so many students. It's not because I'm beautiful to look at. It's because I teach things that work. Look at my results over the past few years. This thing works. And if you want to be a part of this, if you want to build generational wealth through long-term investing, you're welcome to join the academy at patreon.com/Tom Nash. Would love to see you there. That's the next one. Peace.